Okay, good afternoon, my dear students. Good afternoon, good afternoon, good afternoon. I welcome you back for the revision lectures for the topic of ratio analysis. Have you all met earlier? Everyone? Have you met earlier? Have you joined the previous full-fledged chapter discussion topics? Yes, that we are recently anyways having it in the evening sessions, right? We have met, right? So on recorded, okay. So you have met me on the recordings, okay. So now this session is essentially planned to complement those topics, whatever we have discussed in the lectures, right? Whatever concepts that we have covered in the regular lectures, we're going to quickly revise it and also possibly practice few questions. Okay, so we'll revise the ratios once again, their analysis, their interpretation, and then essentially go for discussing about more and more questions. Okay, so let's get started. First, we began with something called as current ratio, and current ratio was essentially looking for what? It was looking for the ability of the company to honor their obligations. So one of the very easiest way to do that is to carry out current ratio or calculate current ratio. The current ratio is basically current assets upon current liabilities. So we have current assets to current liabilities ratios, and as we said, that higher the current ratio, the better it is, because that essentially means that you are having more assets to pay off your liabilities. But that doesn't work always, right? Because obviously we say high current ratio indicates higher liquidity or solvency, but very high current ratio is going to indicate some sort of inefficiencies. It may be due to high level of stocks, high level of debtors, or high level of cash. Third, optimum current ratio, we said, it cannot be very high, it cannot be very low, it has to be 2:1. And of course, if current ratio is less than 1, it means there is a negative working capital. That's your current asset is basically less than your current liabilities. Then we observed that even if we have a current ratio of 2:1, we still may face a problem with regards to honoring our obligations. So like in this case, as we have stated, that we had 4 lakh of current assets, 2 lakh of current liability. And when the creditors are demanding, let's say this 2 lakh rupees, we were not able to honor the entire payment because there were 2 assets which were actually not suitable or not, they're not in actual use for us to calculate to honor the creditors. So we essentially remove those non-quick assets, and then we arrive at the quick ratio, liquid ratio, or the asset test ratio, right? So which is current assets, you reduce the stock and prepaid expenses, and then we have the divided by the current liabilities. We make it even more strict by using cash and cash equivalent and only marketable securities in the numerator. So we are essentially, eliminating the bills receivable and the debtors from it. And then in the denominator, we have the current liabilities. Okay. So these were the 3 ratios. After that, we also calculated something called as basic defense interval ratio. That was essentially the quick assets upon the daily operating expenses. So this was telling us for how many days operating expense do we have to pay without any more funding requirement. So whatever cash we have, that is equal to how many days of our expenses. So we can calculate the daily operating expenses as COGS plus admin expense plus selling expense minus depreciation and non-cash expenses. And then we just divide the entire thing by 365. Okay. So that's your daily operating expenses. Then we have also went ahead with the long-term solvency ratio. So long-term solvency ratio was essentially looking at how sound the company is over a longer period of time. Okay, so over a long term, how sound the company is going to be when it comes to payment of the long term liabilities. So that is computed by some of the ratios like equity ratio, which is equity shareholders funds upon net assets. Then we have the debt ratio, which tells us the total debt upon net assets. Then proprietary ratio was talking of owned funds in the numerator, net assets in the denominator. And the level of long-term solvency again was calculated by using debt equity ratio, which was debt funds, which is total borrowed funds upon equity shareholders funds. After that, we went ahead with this income statement where we stated that the income statement, when it is drafted up to EBIT, it is actually indicating the operational income. And beyond that, everything that happens is financing. So EBIT is basically earning that is made for all the fund providers. Profit after tax is a earning that is there for all owners, right? And net profit for equity shareholders is the earnings that is generated for equity shareholders. So when we want to compute the rate of return, we simply compute it as income upon investment. Okay. Okay. So this is income upon investment. That's your rate of return. Now, if you want to compute the rate of return earned by the equity shareholders, it will be, of course, the income is going to be net profit for equity shareholders upon equity shareholders funds. If it's the rate of return to be earned by the owners altogether, the total set of owners, then it is PAT upon equity shareholders funds, that is plus the preference share capital. And if you are talking of what is the funds what's the rate of return that is earned by the company for all its investments, then it's going to be EBIT upon equity shareholders funds plus preference share capital plus debt. Okay, because this denominator indicate the total set of funds that the company has got. Then we went ahead with something called as coverage ratio, and also we learned about the capital gearing ratio. So capital gearing ratio is basically funds which require fixed rate of return upon funds which do not require fixed rate of return. So which are the funds that require fixed rate of return? That is your borrowed funds and the preference share capital, and divided by the funds which do not require fixed rate of return, which is equity shareholders funds. So higher capital gearing ratio is going to indicate higher risk for the company. Okay. Then again, the risk was measured by using something called as coverage ratios. So interest coverage ratio, we said it is EBIT upon interest. Preference dividend coverage ratio is computed as PAT upon preference dividend. Debt service coverage ratio is computed as earnings available for debt service upon interest plus the principal amount due. Right now we compute the earnings available for debt service by using PAT. You add to that interest, you add back depreciation, amortization, non-cash expenses, add back the non-recurring expenses, and reduce the non-recurring income. Fixed charges coverage ratio is also similar. A quick way to calculate is to add a depreciation to EBIT, and in the denominator we take interest and repayment of loan. Okay. Then activity or efficiency or turnover ratios we have. So these ratios are essentially telling us how actively a company is, utilizing its assets. So the more the number it is, the better is the higher level of activity of the company. So total assets is, let's say, 2 lakh. Sales is 12 lakh and 8 lakh. So how many times of an asset is the amount of sales? So we can say total assets is 2 lakh, sales is 12 lakh. And therefore, we say it is 6 times, and here it is 4 times. So using 2 lakh asset, one company is generating a sale of 12 lakh. Another company is generating an asset of 8 lakh. So which of these assets are going to be, more, which of these two companies are more actively utilizing those fixed or total assets? That's company S. So all these ratios are always going to be in the form of either sales or COGS, that question will provide us, divided by the average total assets. Fixed asset turnover similarly will be sales or COGS upon average fixed assets. There may be total capital turnover. Total capital turnover will be also on the similar line, which will be total capital employed in the denominator, and sales or COGS on the numerator. Current asset turnover also on the same rise, sales or COGS upon average current assets. Working capital turnover is also on the same line, sales or COGS upon average working capital. Now you get average working capital as what? Average current assets minus current liabilities. So any sort of turnover ratio is always going to be sales or COGS. You divide it by the average X. Okay. Then some of the really interesting turnover ratios were inventory turnover ratio, debtors turnover, and creditors turnover. Inventory turnover was simply COGS upon average stock. Now debtors, I cannot use COG. So debtors has to be connected with credit sales. And therefore we had credit sales upon average receivables. Creditors turnover is credit purchases upon average payables. So COGS upon average stock. From that we can actually get the inventory holding period also, which is simply 12 or 365 or 52 divided by the inventory turnover. Debtors collection was 12 or 365 or 52 divided by the debtors turnover. And same goes with the creditors payment period. Okay. So remember that over here receivables include your bills receivable, and here payables will include the bills payable. So that is COGS upon average stock. Here it is credit sales upon average receivables. So these all indicates how many times of the current asset, how many times of inventory or the debtor or the creditor is the corresponding sales or the cost item. Right. The more this number is, the greater is the degree of activity of the company. Okay. Then we have some of the P&L ratios. One was regarding gross profit ratio, which was GP upon net sales into 100. Then we have the net profit ratio, which is net profit upon net sales into 100. Operating profit ratio is computed as EBIT upon net sales into 100. COGS ratio is computed as COGS upon net sales into 100. Operating expense ratio is admin expense plus selling and distribution expense upon net sales into 100. So you can observe all our P&L ratios are of the same format, that everything that you want to compute should be in the numerator and you divide it by the net sales. So like COGS ratio, COGS upon net sales. GP ratio, GP upon net sales. A finance expense ratio, finance expense upon net sales into 100. So all of these items are on the similar format. Then one point to note is return on assets is always going to be computed as net profit after tax, which is EBIT into 1 minus T upon average assets. So all these return numbers are always going to be expressed in terms of percentage, and the denominator will always comprise of averages. Okay. Then we did some of the market ratios. The market ratios were like earnings per share was computed as net profit for equity shareholders upon number of equity shares. Then dividend per share was total equity dividend that you're paying divided by number of equity shares. Dividend payout ratio was DPS upon EPS. Retention ratio was telling us what proportion of the earnings are we retaining. So that is EPS minus DPS upon EPS. And the yield ratios were like what is the rate of return that you are getting as an investor as a percentage of the market price per share. Then we also computed this Q ratio. Q ratio was essentially comparing the market value of the company and the replacement cost of the company. Okay, so one we have this ratio before the Q ratio is market value to book value ratio. Market value is the market price of the share that you observe. Book value of the share is computed as equity shareholders fund divided by the number of equity shares. Okay, so that becomes 1.2. Now Q ratio is computed as market value of the company upon replacement cost of the company. So if your Q ratio is greater than 1, we observe that share price is overvalued. If it is less than 1, then we say that the share price is undervalued. Okay. Now that was quick recap of all the ratios. Now it's time for us to get started with some questions. Okay. Let me just put it in front of you, certain questions. So this is the handout which I have given as homework few questions, but then we'll definitely be solving a lot of them. So let me just go from the last question and then take it forward. Yeah, let's get started with question number 19. Are you all able to see the question, guys?
Yes, sir.
Yes? Okay. I just want you to have a look at it for a minute, read the question in a minute, and then we'll start solving it. Read the question properly, guys. That's the first and the initial prerequisite to get good marks is to read the question carefully, understand the emotions of the question. Okay, try to know what the question is giving you information, what the question is giving you some sort of hint. Okay, so please read the question carefully, guys. Just a minute's time. Okay, having read the question, now will you be able to solve it? Will you be able to solve it? Will you be able to solve it, guys? Or shall I solve it for you?
Sir, we can try.
You can try? Okay.
Yes,
so
sir.
you can just try it in graph, just scribble it off, right? And quickly try to solve it. Maybe I can give you approx 5 minutes for that. Okay. In just 5 minutes, you should be able to quickly solve it. And then we'll have a detailed look at the solution. Let me just put up a timer here. Yeah. Try to solve it quickly, guys. Okay, guys. So time up. Let me get started with it. You can just verify the solutions then. Let me copy it to my Excel file quickly. Yes. Prepare a balance sheet like this. Okay. So what we have is Masco Limited is furnishing the following information to the year ending 31st March 2021. Let's say sales is 75 lakh, return on net worth is 25%, rate of income tax is 50%, share capital to reserves ratio is given 6:4, current ratio is 2.5, net profit to sales after income tax, net profit to sales is 6.5%, and then inventory turnover based on the cost of goods sold is 12, and then cost of goods sold is given 22 lakh 50, interest on debentures, the receivables amount is given, payables is given, bank OD is given. You have to calculate the operating expenses. Now, if you look at the first number, we have the sales figure and we also have the net profit to sales, which is the after tax figure. Okay. Now, rate of tax is also given 50%. So we can simply start with using the formula of return on net worth. So return on net worth is net profit for equity shareholders, right? Net profit for equity shareholders divided by equity shareholders funds, correct? Now, net profit for equity shareholders is given to be 25%, and we have like sales given to us, but then I don't have any of these figures, right? We don't know the net profit for equity shareholders, neither we know the equity shareholders fund. So first we need to look for calculating the net profit. Net profit for equity shareholders. We can actually get that by looking at net profit to sales ratio, which is the after income tax, right? So basically over here, there is no information about the preference shares. So can I say net profit for equity shareholders is same as profit after tax, right? So it is same as profit after tax, and that PAT we can get it as sales, which is 75 lakh multiplied by net profit to sales ratio of 6.5%. So what is the profit after tax figure that we get? 75 lakhs multiplied with 6.5%. So that's 4 lakh 87,500, correct? We got the profit after tax as 4 lakh 87,500, everyone.
Yes, sir.
Yeah, perfect. So now we have to, obviously I can say that net profit for equity shareholders is also same as PAT, and then I can calculate it. But our first target is to get the operating expense. So now for operating expense, we have the net profit to sales, but the COGS is given as 22 lakh 50. Interest on debentures is given. So we just do the backward calculation. So when we do the backward calculation, can I say to PAT, we will add the tax. Now we know that profit after tax of 4,87,500 is, since the rate of income tax is 50%, can I say this is 50%? Right. And of course, we need to further multiply it by 0.5. So this 4,87,000 is 50%. You multiply it with again 0.5. You get the same thing. And then the profit before tax will be just the addition of both. So can I say our profit before tax is 9,75,000. From that, you're going to pay taxes, and then the final PAT figure is this. How do I get the operating expense or EBIT now? For that, I need to add over here interest. Now that interest is also given to us. Interest is 75,000. So when we add back the interest, we'll get the EBIT figure as 9,75,000 plus 75,000. So can I say we just do the backward calculation? EBIT of 10,50,000. From that we subtract 75,000 interest. From that you get PBT. You add less the taxes, and then you get the PAT. So we get the EBIT as 10,50,000, or the operating income is basically 10,50,000. Okay. So net profit to so that is done. Our idea is to get the operating expenses. Now, what is the amount of operating expenses that we have? Like on EBIT, earnings before interest and tax, when you look at the sales flow, it is like you'll have some amount of sales. From that, you will reduce the COGS or COGS, right? And after reduction of COGS, what you get is gross profit, right? So we get the gross profit. From that, you reduce operating expenses, right? You reduce the operating expenses, and then you get the EBIT. Now we obviously say that there is nothing non-operating in this part, and therefore you get the EBIT figure over here, right? So now we already know that EBIT is this number, and I have to calculate the operating expense, right? So do we have the COGS number? Yes, we have the COGS number, right? So I can just simply say that this is 75 lakh, correct? We know the COGS as 22 lakh 50,000. So we get a gross profit of
52 lakh 50,000.
52 lakh 50,000, and we have a EBIT of 10 lakh 50. Now, of course, this particular figure that we have, which is the difference between these two, is 42 lakh, and this is what we really wanted as the operating expense. That's the balancing figure of operating expense. Did we all get it? Yes, guys?
Sir. यहाँ तक सही था.
Sorry?
यहाँ तक ठीक था, ऐसे सेम था सर.
सेम है ना? हाँ, इसके आगे अभी पूरा बैलेंस शीट बचा है ना? Now we have the balance sheet to fill. So first part is done. The operating expense is done. Now coming to the balance sheet. Okay. So in this balance sheet, the first ratio that we'll use is return on net worth. Now, whenever you want to prepare a balance sheet or any other financial statement in this ratio, try to always use 1% and a corresponding number related to that percentage. Like return on net worth, which is the number which is related to net worth that we have already obtained right now. Can I say profit after tax? Because return on net worth is computed as net profit for equity shareholder upon equity shareholders fund. And this is obviously going to be PAT upon equity shareholders funds in our case. So we know that return on net worth is given as 25%. Okay, so this 25% is equal to profit after tax of 4,87,500, and then we have equity shareholders funds. Okay. So finally, equity shareholders funds will be 4,87,500 divided by 25%. So we're getting the equity shareholders funds as 19,50,000. Now, is this equity shareholder fund equal to only the share capital?
No, reserves and surplus
It's
also.
a combination. It's a combination of share capital as well as reserves. So let's check. Do we have some sort of information regarding reserves or any ratio?
Yes, the share
Yes.
capital to reserve is 6.
There is a ratio of share capital to reserves, right? So share capital to reserves is there. Now, this 19,50,000 need to be distributed in that ratio. So we have like equity share capital is to reserves ratio. So this ratio is given as 6:4. So this is like 6:4. Some disadvantage of using Excel. It always takes some format of its own. Okay, so equity share capital reserves is 6:4. Now this 19,50,000 has to be split into two parts: equity share capital and reserves. Can you tell me what will be the amount of equity share capital? It will be 19,50,000, but multiplied by what? Can I say 6 divided by 10?
11,70,000 is 7,80,000.
Correct. So this is divided by 10 into 6. So 11,70,000. And then we have the reserves also. So reserves obviously, you can say same thing, 19,50,000 multiplied by 4 divided by 10, which is 19,40,000, 50 into 4 and divide by 10. So this is 7,80,000. Okay. So two numbers we have computed. One is share capital, one is reserves. Okay. Then other things are like debentures. Acha, can we get the debentures? Yes, because we have the interest on debentures number. Right. So since we have the interest on debentures number, we can easily get the debentures. So interest on debentures. This is given as equal to how much? Interest on debentures? 75,000. Yes. This is 75,000. We know that then the debentures value will be simply 75,000 divided by the rate of interest. Rate of interest is given over here, 15%. So the amount of debentures
5 lakhs
is equal to 75,000 divided by 15%. 5 lakhs. Perfect. So from the liabilities, three parts are done: share capital, reserves and surplus, and 15% debentures. Payables is already given to us. Right? Payables is already given to us. Now bank term loan, there is no information about bank term loan. There's a mistake over here. This is not term loan. This is bank OD. Okay. Because there's no other information about bank term loan, right? So obviously this 1,50,000 will come over here. So liability side, everything is sorted, correct?
Yes, sir.
Now coming to the asset side. Even on the asset side, receivables of 2 lakh is already taken care of. We need to look at the stock and other aspect. So for that, we'll have to take help of the number of current ratio, inventory turnover. Yeah, let's use the inventory turnover now. Inventory turnover. Inventory turnover ratio. What will be the inventory turnover ratio given to us? Inventory turnover ratio is given as 12. And this is based on COGS. So can I say it will be COGS upon stock or inventory is 12. We have the information about COGS, right? COGS is
22 lakh
50. Yes, 22,50,000 divided by stock will be equal to 12. So what will be the value of the stock?
1,87,000.
1,87,500. Correct? So stock is done. Stock is done. Then receivables portion is already given to us. Cash is something we'll be getting like a balancing figure, and for that we'll have to take help of
Current asset ratio.
Current ratio, yes. We'll take help of current ratio. So current ratio is current assets upon current liabilities. Current ratio is
2.5.
given as
2.5.
2.5.
2.5. So 2.5 will be equal to current assets. Current assets will comprise of stock, receivables, and cash. Stock plus receivables plus cash, and this thing is divided by current liabilities comprise of
Payables and
bank
overdrafts.
payables and bank OD. Yes, payable plus bank OD. So this 2.5 is equal to, we've got the stock value as 1,87,500. To that we will add the receivables. Now
2 lakh.
receivables amount is given as 2 lakh. And even to that we need to add further cash, right? So it is like 2 lakh plus cash, and this entire thing divided by the amount of payables and bank OD is given already. Payables is 2,50,000, bank OD is 1,50,000.
4 lakhs.
That's 4 lakhs.
So total it is 4 lakh. Yes. So now we can solve it and get the value of cash.
6 lakhs, 12,500.
4 lakh into 2.5 minus 1,87,500 and minus 2 lakh.
6,01,1200.
6,12,500. Correct. So that's the cash balance that we have got. Okay, so we are done with cash, receivables, and stock is done. Current asset total is also done. Now fixed asset is left. How do we get the fixed asset now?
Total
Balancing figure.
Yes, total asset is equal to total liabilities, right?
yes.
Total assets should be equal to total of liabilities. So now total assets will be equal to fixed asset plus current asset. That will be equal to total liabilities will comprise of what? Shareholders fund, right? Equity shareholders funds plus debentures plus current liabilities. Now fixed asset is something we don't know, but what's the value of current asset?
10 lakh. 10 lakh.
Current asset, it is 187,500 plus 2 lakh plus 6,12,500. That is equal to equity shareholders fund. That is what we have got, 19,50,000 plus debentures of, what is the amount of debentures? We have got the debentures 5 lakh, right? Debentures of 5 lakh plus current liability of 4 lakh. And so on solving this, you will get the fixed asset also. Yeah. What's the fixed asset, guys?
18,50,000.
18,50,000. Correct. So we are done with this. Our balance sheet items are fully matched. And obviously the balance sheet is going to be tallied automatically. Are we good with this question, everyone?
Yes, sir. Yes.
Okay. Shall we go for next question? No.
Yeah.
Okay. Let's take up the next question, everyone. Yeah. Question number 16. I'll solve September 24. In fact, that question is there, not September 24, sorry. Because the exam just happened and this was prepared way back. We'll solve this question 20, which was the May 24 exam question. Okay. We'll discuss that. But before that, let's do some more questions. Question number 16. Would you like to solve it and then I'll follow, or you want me to solve it?
The first we will solve it.
Will solve? Okay, great. So again, for this, I'll give you the same 5 minutes timer. 1 second. There is some problem with this sharing. Yeah. Here we go. The time starts now. Come on, guys.
Sir,
Yeah.
when nothing is mentioned, then we have to take inventory turnover ratio with COGS or with sales.
With COGS. Unless it is specifying you for sales. If the question says you need to take it on sales, then take it on sales. Otherwise, it has to be always on COGS.
Okay, thank you.
Yeah. Okay, time up, guys. Let's get started. Fixed asset turnover is given, capital turnover, inventory turnover, receivables turnover, payable turnover, GP ratio is 25%. Gross profit is 8 lakh. There is no long-term overdraft. Reserves and surplus amounts to 2 lakh. Ending inventory of the year is 20,000 above the beginning inventory. Now, when you have the relationship between ending and beginning inventory, it means we are supposed to be using the average inventory thing. We have to calculate various assets and liabilities from the balance sheet of Tirupati Limited. Okay. So let me just take it there itself. Or let me have it as it is. Question number 16. Now this balance sheet, let's prepare the format of balance sheet first. Because in the previous question, balance sheet format was given. Here it is not given. So let's first prepare the format of balance sheet, because that will actually help us, give some sort of guideline as to what we are supposed to calculate. So we'll have, let's say, liabilities. Amount, assets, amount. Okay. Now, liabilities, what all things are required to be filled up? Let's write it down over here. So in the liabilities, what are we going to have, and what in the assets, what are we going to have? So we have like capital turnover. So we'll have the capital employed, but that in that, what is the amount of debt and all, that is not given. But there is no long-term loan or overdraft. So there is no long-term loan or overdraft. So this company is purely equity funded. So we'll have like equity share capital. And do we have any bifurcation regarding the reserves? Any information is given about reserves? Yes, it is. Just close it and open it. Yeah, equity share capital. Reserves, there's no bank overdraft or long-term loan. And what we have is payables are there. So I think that should be the only liability. Let me write it over here. Payables. And on the asset side, we have fixed assets, inventory, receivables, fixed assets. Then you have like inventory, receivables, fixed asset, inventory, receivables, and maybe we'll have something called as other current assets. That's it. Let me just, there's some technical issue happening here. Let me just open it again. Some software glitch. Problem. Okay. She is working on it. जल्दी कर भाई, पनवेल निकलना है. challenges, technical challenges, guys. Come on. Anyways, let me, till the time that things get sorted, let me do it on paper mode only. So first, did we use the fixed asset turnover, right? So fixed asset turnover, no, we start with our calculations of using the GP ratio. So from the GP ratio, you can get the sales value. What is the value of sales?
32 lakh.
Can I say 8 lakh divided by 25%, which is 32 lakhs. And of course, what will be the value of COGS? 24 lakhs. Correct? So sales is 32 lakhs, COGS is 24 lakh. Now using this fixed asset turnover, can you tell me what will be the amount of fixed asset?
8 lakhs.
It's 32 divided by 8 times.
4 lakh.
How much?
4 lakh.
4 lakhs. Then how much will be the capital? Capital will be nothing but equity share capital plus reserves. So this is going to be 32 lakhs by 2. 16 lakhs.
Yes, sir. 16 lakh.
Now inventory turnover. Inventory turnover will have to take help of COGS upon average inventory. Now we know COGS. COGS is 24 lakhs upon average inventory is 2. So what will be the value of average inventory? 12 lakhs.
So inventory turnover ratio is 8 times.
Inventory turnover ratio is, sorry, 8 times. Okay, 8. So if this is 8, then average inventory is 3 lakhs. Right? So average inventory is 3, and they're saying that ending inventory is 20,000 above the beginning inventory. So how do we resort to this then? Can I say average is 3 lakhs? So it will be opening plus closing divided by 2 is 3. And the second equation they say is ending inventory, which means closing minus opening inventory is 20. I mean 20,000. And this is 3 lakh. So of course opening plus closing is 3 lakh and closing minus opening is 20,000. Now when we solve both of them, what is the value of closing stock and opening stock that we get?
Opening stock 2 lakh 80,000.
Closing is 3 lakh and opening is 2 lakh 80. Is it? No.
Sir, opening is 2 lakh 90,000. Closing is 3 lakh 10,000.
Yeah, opening is 2 lakh 90 and closing is 3 lakh 10,000. Correct? Right, guys? Just need to solve both the equations. Let me just check if this has got sorted. No, not yet. I don't know what's wrong with that now. We'll see that later. Anyways, so closing stock is 3 lakh 10,000. So we have used capital turnover, fixed asset turnover, inventory turnover. Now receivables turnover. Using receivables turnover, you will get the value of debtors. So receivable turnover is 4 times. So we have to assume entire sales is on credit basis. So receivable turnover is 4. How do we get the receivable turnover? Receivable turnover is computed as sales upon receivable is 4. So what is the value of sales?
8 lakh.
Sales is, what is the value of
8
sales?
32
8
lakh.
32 lakhs.
32 lakh.
Upon receivables is 4, so we get the value of receivables as 8 lakhs. Correct? Right, guys? Yes, did we get the receivable as 8 lakh?
Yes, sir.
Okay. Now coming to the payable turnover. Now how do we get the payables turnover? Payables turnover calculation is, how do we calculate payable turnover?
Credit purchases upon.
Yes, credit purchases upon payables. Now we know payables turnover ratio is 6 times. So 6 equal to, how do you get the credit purchases? Because purchases have not been given. But we know the COGS, we know the opening and closing stock. So using COGS, opening and closing stock, can we compute the credit purchases? Yes. So it will be COGS plus closing minus opening upon payables. So of course 6 equal to, what is the value of COGS that we have got? 24 lakhs. COGS is 24 lakhs plus closing stock was 3 lakh 10,000 minus opening stock is 2 lakh 90,000 divided by payables. So payables will be 24 lakh plus 3 lakh 10 minus 2 lakh 90, and then the whole thing divided by 6. So what is the value of payables?
4 lakh 3,333.
Okay, so it is 24 lakh plus 3 lakh 10,000 minus 2 lakh divided by 6. Yes, so 4 lakh 18,333.3 is the value of payables. And I think we have got everything. We just need to draft the balance sheet now. Right, so we just need to simply draft the balance sheet. So let us draft the balance sheet quickly. Okay. So balance sheet. Fixed asset. What's the amount of fixed asset we got? 4 lakhs. Then we have got like stock, receivables, other current assets. And on the liabilities, we have like share capital.
Sir, please check the payables once more.
Payables.
Yes, sir.
403. 4,003. 4 lakh
4,000.
3,000. 4 lakh 3,000.
Okay. 3,333. There is a mistake. 24 lakh plus 3 lakh 10,000 minus 24 lakh plus 3 lakh 10,000 minus 2 lakh 90,000. 24 lakh 20 divided by 6. Yeah, correct. So this is 4 lakh 3,333. Okay, so here we have the payables and also then the reserves. So payables are like 4 lakh 3,333. Value of stock, closing stock was 3 lakh 10,000. What is the value of receivables?
8 lakhs.
Was 8 lakh, yes. And then we have like reserves and surplus is 2 lakh. So what will be the share capital? Share capital is 16 lakh. right? And of course, this will be your balancing figure as the other current asset. So what's the balancing figure for other current asset? Other current asset balancing figure. 6 lakh plus 2 lakh. So this is 22 lakh, 3,333. And on this side, we have 4 lakh plus 3 lakh 10,000
93,333.
plus 8 lakh. And then minus 22 lakh, 3,333. 37 lakh 13,333, correct?
Sir, 6,93,333.
6 lakh 90,000. I don't know, maybe my calculator is like 4 lakh plus 3 lakh 10,000 plus 8 lakh. This is 15 lakh 10,000 minus 22 lakh 3,333. 6 lakh 93. Yes. So this is 6 lakh 93,333. Okay. Did we get this? Question number 16, everyone?
सर
Yeah.
वो जो पार्ट है ना इक्वेशन सॉल्व करने वाला सर वो करके बताओ ना एक बार.
कौन सा? ये ओपनिंग प्लस क्लोजिंग एंड क्लोजिंग माइनस ओपनिंग वाला? Yeah. See. See, opening plus closing, it is 6 lakh. Right? And then you have like minus opening plus closing is 20,000. You just add them. So 6 lakh plus 20,000. ये भी plus होगा, ये भी plus होगा. तो 6 lakh plus 20,000 is 6 lakh 20,000. And this is 2 closing. So the opening minus opening cut हो जाएगा. So closing will be 3 lakh 10,000. और closing आ गया तो you can substitute in any one of them to get the opening.
ओके सर समझ आ गया.
Okay.
ओके.
Okay. चले next question guys. देख लो जरा भाई एक्सेल सुधर गया भाई, अभी भी नहीं सुधरा है. क्या तकलीफ हो गया इसको एक्सेल को आज? Maybe there is some server problem at the Microsoft end. Anyways, we can do it in pen paper mode also. Shall we go for next question guys?
यस सर.
Yeah. Okay. So एक काम करते हैं. Let us do with this question number. Fixed asset turnover. कोई भी turnover ratio होगा, that's going to be always taken on sales, right? Except the inventory. Inventory के लिए default item is COGS. बाकी सब के लिए default item is sales. Payables के लिए obviously default item is purchases. If the question says that it is based on COGS, then only you have to take it on COGS. Okay. Then let's go ahead with this question number 15 now. Here it is required to prepare the trading and P&L for the year ended. Okay, trading and P&L account. So trading account and P&L account, you can prepare it in vertical format. Okay, so like you start with sales. Okay, less you will talk of COGS. Now in that COGS you will talk of what is your opening plus purchases less closing, right? So you'll have your sales figure. You'll have like opening plus purchases less closing. Then you get the COGS. Then you get gross profit, right? From gross profit, you're going to reduce other operating expenses, that will give you like EBIT. Okay. Then from EBIT, you're going to reduce the interest to arrive at profit before tax. From that, you will reduce the tax to arrive at profit after tax. Now, of course, there is no mention of preference shares. Otherwise, you would have taken that part also. Okay, so the format is in front of you. Would you like to solve this question on your own?
Yes.
Yeah, chalo, great. Solve it, guys. In exam, we can make format vertical or horizontal, both ways acceptable. You can prepare horizontal or vertical, both. There's no problem at all.
The return on equity means EBIT.
Return on equity means PAT upon or net profit for equity shareholders upon equity shareholders fund. Okay, time up. Let me start. I don't know. Maybe let me just take up a. No, blank is not opening. So we have a list of blank book opening. I don't know. Something wrong going on here. Do it over here itself. Yeah, question number 15, guys. Let us get started. VRA Limited has provided you the following information for the year ended. So we have like debt equity ratio and 14% debt equity ratio and 14% long term debt. So of course, we can use that ratio of debt equity. So debt upon equity is 2:1. Now we know the amount of debt. Amount of debt is 50 lakhs. So amount of debt we say 50 lakhs upon amount of equity is 2. So that essentially gives us the value of equity as
25 lakhs.
25 lakhs. Okay. Now based on this equity, we have a GP ratio and return on equity. Now the connecting with equity is the return on equity part. So let me just use the return on equity number. So return on equity number will be, return on equity is like 50%. So we know return on equity is computed as profit after tax upon the equity component, which is 0.5. So PAT upon equity of 25 lakh is 0.5, and therefore profit after tax will be 0.5
12 lakh 50,000.
12 lakh 50,000. Yes. So you got a PAT of 12 lakh 50,000, right? Okay. Then after this PAT of 12 lakh 50, next is to go for like in the P&L statement we're done with the PAT. For the other components, we need like net profit ratio or anything of that sort. We have the income tax capital turnover ratio is there. Okay, so capital turnover ratio will help us to calculate the amount of sales. So capital turnover will be sales upon total capital employed. Now, capital turnover ratio is already given to us in the question to be 1.2. So this 1.2 is equal to sales upon total capital employed will be equity plus debt. So 1.2 equal to sales is to be computed. Equity is 25 lakh and there is a debt of
50 lakhs.
lakhs. So we can say sales is 1.2 into 75 lakh,
90 lakh.
90 lakh. Now, once we have got the sales, now it's easy for us to really talk about the gross profit because already GP ratio is given to us. So gross profit will be sales multiplied by
30%.
gross profit ratio, which is 30%. So sales is 90 lakh, right? Sales is 90 lakh into 30%, guys. So that will be 90 lakh into 30%,
27 lakh.
27 lakhs. If GP is 27 lakhs, COGS will be, can I say sales, which is
63 lakh.
90 lakh minus 27 lakh. That
63
works out
lakhs.
to 63 lakh. Okay. So here we have like sales less COGS. COGS is the number that we have got. We need from this, in this statement, we need the value of purchases also. So opening and closing stock information is given to us. Opening stock is 4,50,000. Closing stock is 8% of sales. Okay. So we'll first say what is the closing stock. Closing stock is 8% of 90 lakhs.
1 lakh 20,000.
1 lakh 20,000 is the closing stock, right?
7
No,
lakh
sir.
20.
7 lakhs.
7 lakh.
7 lakh 20,000. Yes. So how do we get the value of purchases? Purchases will be COGS plus closing stock minus opening stock. COGS, we know it is 63 lakhs. Right, plus closing stock of 7 lakh 20 minus, we have the opening stock value.
4 lakh 50.
Opening stock is 4,50,000. Yes. So 63 lakh plus 7 lakh 20 minus 4 lakh 50. How much is this?
65 lakh 70,000.
65 lakh 70,000 purchases. So purchases is 65 lakh 70,000. So as far as this statement is concerned, we know the sales, we know the opening, we know the purchase, we know the closing. Gross profit is done. Other operating expense and EBIT is something that we need to look at now. Now, how do we calculate the other part? Well, interest is what we can get. Let's start preparing this statement because automatically I think balancing figures will come up. Sales was 90 lakh less COGS. You'll have like opening plus purchases less closing. So opening stock is 4 lakh 50 and we got the purchases as 65 lakh 70 and closing is 7 lakh 20. So what's the COGS? We have got the COGS also. COGS was 63 lakh, right? And then from that we subtract it and we got the gross profit. Gross profit stands as 27 lakh. From 27 lakh we need to reduce the operating expenses to arrive at EBIT. From that we should reduce the interest to arrive at profit before tax, and then from that we reduce the tax to arrive at profit after tax. I think we have got the profit after tax figure.
Yes, sir.
That is
12
12
lakh
lakh.
50,000.
Yes, 12,50,000. And we know the tax rate also. Tax rate is 35%.
35%.
So what will be the tax amount? Tax amount will be 12,50,000 divided by 1 minus 0.35 into 0.35, right? Because that 12,50,000 is after deduction of 35% tax. So
6
12,50,000,
lakh.
yeah, 6 lakh.
673,077.
6,70,000,077.
Sir, 6,73,077.
73,077. 6,73,077. So going by the backward calculation, PBT will be 19 lakh
23,077.
077.
Then interest will be, anyways, it is 14% of 50
10
lakh.
lakh.
So 14% of 50 lakh will be 7 lakh.
7,70,000.
7 lakh only, na? 14% of 5 lakh, 50 lakh is 7%. 7 lakh, sorry. Then EBIT will be again the backward calculation, which will be 26 lakh
23,077.
Now can I say this here will have a balancing figure of
7,69,23.
no 7 lakh 69.
76,923.
Yes, 76,920. Correct. Okay, so that is the income statement, the complete income statement as far as question 15 is concerned. Are we all good?
Yes.
Okay, then let's take a break, guys. Break of 10 minutes. And then we'll come back and solve few more questions of ratio. Yeah. Yes. Capital turnover is simply the capital employed, right? Sales upon total capital employed. So all turnover ratios we have seen, it is sales upon total upon anything. So it is capital turnover, it is sales upon total capital employed. Okay. Anmol.
Teacher.
Yes.
Please,
Yes, Sanket sir. You have your hands raised. Do you want to say something?
स्टूडेंट सर, ये जो सीए संकेत सर हैं, आई थिंक ही इज फेक.
अच्छा.
यस सर.
ओके.
अगर ये अभी आते हैं तो फिर इनको सर रीनेम के लिए बोल दीजिएगा आप.
जी. Okay. So let's take a break now, guys. Break of 10 minutes, and then we'll come back and solve maybe 1 or 2 more questions. Chalo, let's get started. Yeah. So that's question number 15. Now let's go for the next question, which is question number 14, guys. Excel has started working now, or it hasn't yet. Not sure. It's still problematic. There is still some problem going on. Anyways, you can just start with question number 14, guys. Now, this is a fairly good question because it's asking you to prepare the summarized P&L as well as balance sheet. Okay. So for this question, I would give you some time. Let's say more than that. 2 minutes more than that. Okay. Try out, guys. Question number 14. You'll solve it, everyone?
Yes, sir.
Yeah. Okay.
Yes, sir.
Sure. Try out question number 14, guys.
Sir, actually, I have a doubt.
Mm-hmm.
Sir, while calculating earnings available for debt service, why are we required to add non-cash expenses?
Because non-cash expenses are not paid by us, right? So they are just book entries, correct? So when I want to repay my loan or when I want to pay the interest, I need to know what is the amount of cash that I have. So therefore, we add back the non-cash items so that we know the exact amount of cash that is available with us to make payment of the debt dues, maybe interest or maybe the amount of repayment of principal.
Okay, sir. Thank you.
Yeah. Okay. Okay, so we are done. Let me just start sharing it. Okay, let me just see if this starts functioning now. Bad news. Still not functional. Anyways, so let's do it on pen paper. Question number 14, guys. So we have the following accounting information and the financial ratios of PQR Limited related to year ended 31st March 2006. GP is given 15% of sales, net profit is 8% of sales, raw material consumed is 20% of work cost, direct wages is 10% of works cost, stock of raw material is 3 months usage, stock of finished goods is 6 months of work cost, and debt collection period is 60 days. All sales are on credit. Then certain ratios that we have: fixed asset to sales, fixed asset to current assets. Then we have the ratio of current ratio, long-term loan to current liabilities, capital to reserves and surplus. Value of fixed assets is given. You know what? In this entire question, everything is just ratios, percentage, and then ultimately what we have is, only one number is given to us, and that is the fixed asset to sales. Only that number is given, and using that one single number, we'll be actually calculating the other items also. Okay, so let's get started with this question number 14. Yeah, question 14. So what we have is gross profit again on sales, everything is sales. Which ratio to use initially? Because we have only one number, that is 26 lakh for fixed assets, and then fixed asset to sales is 1:3, right? So fixed asset to sales is 1:3. Let's use that ratio first. Okay, so it is fixed assets to sales, right? So fixed assets upon sales is given to us to be 1/3. So fixed asset is 26 lakhs upon sales, that is 1/3. So we can get the sales value over here as 26 lakh into 3. So how much is that?
78 lakh.
78 lakhs, yes. So we got the value of sales as 78 lakh. And before we go ahead and proceed with other calculations, let's try to set a format of P&L and balance sheet that is required, so that we will at least have an idea what all things we are supposed to calculate. So let's say we'll of course need the sales. Let me just do one thing. Let me place it downside. Yeah. So we want the statement of P&L, or this is like summarized profit and loss. We will start with, of course, sales. From that, they have used the word something called as works cost. Works cost has to be taken in synonymous with the COGS. Okay, so less works cost. Okay, will give us the gross profit, right? So then we have like the other operating expenses, because gross profit is given, net profit is given. And do we have any sort of loan in this question? Long-term loan to care liabilities, yes, we have it, right? So of course from this
examination.
we will subtract operating expenses. That will give us
Mute my
EBIT.
microphone button. My microphone button.
Okay. That will give us EBIT. From EBIT, we are going to subtract the interest to arrive at profit before tax. And then from the tax, we subtract to get the profit after tax. Okay. This is the summarized P&L that we are looking to create. Then same way, balance sheet. Let's have an outline of balance sheet also. So in the balance sheet, what all items do we really need?
Live virtual classes intermediate for January 2025 exam.
Balance sheet. We will have definitely fixed assets, current assets. Then in the current assets, we have stock of raw material, stock of finished goods. Okay. Stock of raw material, stock of finished goods, direct raw material consumption is also given, guys. So again, my summarized P&L is going to further get expanded. Okay, because we have this works cost available with us. So of course, a lot of other things needs to be calculated here. So like from sales, we are going to subtract the works cost. Subtracting works cost will be like raw material consumption, right? And there is something information about labor also. We have information about wages also. So wages, then we will say other direct expenses. Maybe we'll get some sort of balancing figure as other direct expenses. So will be like sales, and then from that, this entire works cost will be subtracted to arrive at gross profit. Okay, so we will have this summarized P&L, and in the balance sheet now, of course, since we are looking at this balance sheet, we will have we'll have fixed assets. Okay, and after that fixed assets, then we also have the current assets. Now, current assets will actually comprise of lot of items, right? So that will comprise of raw material stock, then finished goods stock. Since we have debt collection period also, we'll have debtors or the receivables balance, and we'll say this may be others. So these current assets will comprise of these items. In the current liabilities, we have long-term loan to current liabilities, and there doesn't seem to be any specific information about other current liabilities. But yes, we will have equity share capital, reserves, and capital to reserves and surplus. We have equity share capital, reserves, and then long-term loan to current liabilities. So we will have like long-term loan and then current liabilities. So these are the items that we need to find out to complete the entire solution. Out of which one of them we have obtained, which is the sales. So sales is 78 lakhs, right? So sales is 78 lakhs. Now let's go for computing the other items. We have the gross profit, which is 15% of sales, right? So we can easily get that number. Gross profit.
11.7.
Yeah. So gross profit is actually 15% of sales. 15% of 78 lakh, right? So how much is 15% of 78 lakhs?
11 lakh 70,000.
11.7 thousand.
7 lakh?
11 lakh 70,000.
11 lakh 70,000, yes. Okay, so we got the gross profit as 11 lakh 70,000, but that will actually help us to know what is the works cost or COGS. So works cost or COGS. Works cost or COGS is simply sales minus gross profit. So sales is 78 lakhs minus gross profit. What will be the amount of gross profit? That's already computed, 11 lakh 70.
66.3.
So works cost is how much?
30,000.
60 lakh. 66 lakh.
30,000.
66 lakh 30,000. Yes. So works cost we get as 66 lakh 30,000. Okay. Now this is the final figure of net adjustment of all the three items, right? We don't have any information regarding opening stock of finished goods or closing stock of finished goods as such. So all these consumption wages will be obviously proportion of these items. So then we have net profit is 8% of sales. So we can get the net profit. Net profit. The net profit is 8% of sales. So that is essentially 8% of 78 lakhs. So what is 8% of 78 lakhs?
6 lakh 24,000.
6 lakh 24,000.
6 lakh 24,000. So we get the net profit as 6 lakh 24,000. Okay. Then next one. Raw material consumption is 20% of works cost. So we say raw material consumed will be 20% of works cost. So it is 20% of works cost, which is 20 upon 100 into works cost is 66 lakh 30,000. So how much does this work?
13 lakh 26,000.
13 lakh 26,000. So we got the raw material consumption 13 lakh 26,000. Okay. Then after that, next item is direct wages, which is 10% of works cost. So direct wages is 10% of works cost, right? Then this will be 10% of
66,30,000.
6 lakh.
66,30,000. So it will come to 6,30,000. 6,63,000.
So 10% means this is 6,63,000. So 6,63,000 is the amount of wages. Can you tell me what will be the other direct expenses? Of course, the balancing figure. So what is the balancing figure? 66,30,000.
46,41,000.
Yeah, 46 lakh.
41,000.
41,000. Okay. 46,41,000. That's the other direct expenses. Now, going into the next data, stock of raw material is 3 months usage. Stock of finished goods is 6 months of works cost. Okay. So let's first say stock of raw material. Stock of raw material is 3 months usage. 3 months usage, which will be 3 by 12 into raw material consumption. So that's like 3 by 12 into how much is the raw material consumption? 20% of the works cost, which is already computed. Raw material consumption is 13,26,000. So what's the stock of raw material?
3,31,500. 3,31,500.
3,31,500, right? 3,31,500 is the stock of raw material. So that will go into our current assets. 3,31,500. That's the amount of stock of raw material that we have got, right? Then the next item, stock of finished goods is 6% of works cost. So stock of finished goods is 6% of works cost, right? So that's 6% of works cost, which is 6 upon 100 into works cost was anyway 66,30,000. So 66,30,000 into 6%, which is 3,97,800. Correct?
Yes, sir.
Stock of finished goods 3,97,800. So in the balance sheet, we'll write it as 3,97,800. So that is done. Next. Okay, debt collection period is 60 days. Debt collection period is given in the question as 60 days. Are we going to assume any number of days like 360 days वगैरह कुछ assume करना है? Anything to be assumed like 360 days?
Yes, sir.
Yeah.
We can achieve.
Yes, sir.
Yes.
Then.
So if you assume 360 days, it'll give you some rounding answer. If you're not assuming you're taking the full
13 lakh.
value, then it'll be different.
Answer will be 13 lakh. 13 lakh.
13 lakhs.
13 lakhs, sir.
So debt collection period is 60 days. So how do we get that number? We get this as simply debt collection period is 60 days. So we can simply get the debtors value. So debtors will be
सर टैक्स असिस्टेंट का कुछ मैसेज है टैक्स असिस्टेंट का कुछ मैसेज है चैट पे आप चलो
नहीं there is some spam guy. वो imposter है, टाइम पास कर रहा है, इग्नोर मारो उसे. Yes, Hardik. हार्दिक ड्यूपॉन्ट करेंगे बेटा. नेक्स्ट क्लास है ना, एक और क्लास है, उसमें ड्यूपॉन्ट करेंगे हम लोग. डोंट वरी, ड्यूपॉन्ट आराम से हम लोग करेंगे विथ रेशियो प्रॉपर. मस्त समझाएगा तुम लोग को, मजा आ जाएगा तुम लोग को एकदम ड्यूपॉन्ट पढ़ के. ओके, सो डेटर्स विल बी सेल्स इनटू 60 by 360 अज्यूम करते हैं. तो सेल्स वाज कितना था यार, भूल गया मैं. सेल्स
78 lakh.
78 lakh, yes. So sales was 78 lakh. Is 78 lakh पे into 60 by 360 कितना होता है?
13 lakh.
13 lakhs. Okay. So we got the debtors as 13 lakhs. ठीक है, आगे देखते हैं. और then we have fixed asset to sales. वो तो यूज हो गया सर. Now fixed asset to current assets. ठीक है. So we have the ratio of fixed assets to current assets. Fixed assets to current assets. Fixed assets to current assets, it is 13:11. So what is the value of fixed assets? Fixed assets is, अपने को पता है fixed asset 26 lakh है, right? Fixed asset 26 lakh दिया हुआ है. So this is 26 lakh upon current assets is 13/11. So of course this will give us a value of current assets to be equal to 26 lakh into 11/13.
22 lakh.
22 lakhs, yes. करंट एसेट्स आ गया 22 lakhs. अच्छा, करंट एसेट्स अगर आपका टोटल 22 lakhs है, if I add these items that you have already obtained, just check कितना आता टोटल, because हमें तो टोटल 22 lakhs बाहर चाहिए. So what should be the others balance? Balancing figure होगा ना, कितना आता है ये बैलेंसिंग फिगर देखो जरा. 22 lakh
48 lakh.
minus 331,500 minus 397,800 minus 13 lakh. 1,70,700, right? Correct? Please check with the others value.
Yes, sir. 1,70,700.
1,70,700. Okay, perfect. Then current assets is done. Let's look at the other item. Then we have current ratio. Okay, so current ratio से current liabilities आ जाएगा अभी. So we have like current ratio. So current ratio is calculated as current assets upon current liabilities. You know, current assets upon current liabilities का number is 2:1. Therefore, current assets में आया था सर 22 लाख. Current asset is 22 lakhs upon
Then it will be 11.
7 lakh.
current liabilities. That is 2. So what will be current liabilities?
11 lakh.
11 lakhs.
11 lakh.
Current liabilities is 11 lakh. Okay. So current liability is okay 11 lakh. Next, और क्या बोला? Long-term loan to current liabilities. Long-term loan to current liabilities now. So long-term loan upon current liabilities. Long-term loan to current liabilities, the ratio is given as 2:1. So current liabilities, so we know current liabilities is 11 lakh equal to 2/1. So what will be long-term loan?
22 lakh.
Yes,
22 lakh.
long-term loan is 22 lakhs. So over here, long-term loan is 22 lakhs. Equity share capital and reserves. Sorry, अब वो बचा है. And for that, they have given us the ratio as reserves, I mean capital to reserves and surplus. The capital to reserves and surplus, today we'll need the total
Net assets.
net assets. So we can say equity shareholders funds will be total assets minus outside liabilities. Minus outside liabilities. Now, what's the value of total assets? Total assets, कितना है total assets?
48 lakh.
Fixed asset लिखा नहीं ना? Fixed asset is 26 lakh. Yeah. So total assets is 48 lakhs. Total assets is 48 lakh minus outside liability will comprise of two things. One is long-term debt and other is current liability. So we'll have like long-term loan and current liabilities. Okay. So we have this as 48 lakh minus what is the long-term loan?
22 lakh.
22
Long-term
lakh.
22 lakh and current liability 11 lakh. This is minus 22 lakh minus 11 lakh. So what is this number?
15.
15 lakh.
15 lakh.
15 lakhs. Now we have this as equity shareholders funds as 15 lakh. That's a cumulative effect of reserves and surplus. Now we have the capital to reserve ratio 1:4. So capital to reserves is 1:4. So how will we calculate the equity share capital? Equity share capital will be 1/5 times of 15 lakh.
3
3
lakh.
lakh.
3 lakh. And then we have the balancing reserves. Reserves will be 4/5 into 15 lakh.
12 lakh.
12 lakh.
12 lakh.
12 lakh. Sure. Let's post it over here. Okay. So we have the total 33 plus 48 lakh. So we get a balance sheet total of 48 lakhs. Did we all get this numbers?
यस सर
Yes,
ये
sir.
क्या बोलते हैं हम लोग ने ना वर्क्स कॉस्ट में जो क्या बोलते हैं ओपनिंग स्टॉक ऑफ रॉ मटेरियल्स फिर माइनस करके क्लोजिंग स्टॉक ऑफ रॉ मटेरियल्स ऐसा क्यों नहीं किया?
We don't have information of opening stock of raw material. Only closing stock is available. La? Do we have information of opening stock?
No, sir.
No, na. If
No,
that
sir.
would have given, then we would have done that opening stock of raw material, add raw material purchases, less raw material closing stock, add wages, direct expenses, then add opening stock of finished goods, less closing stock of finished goods. So all those things we would have done had we been given the information about the opening stock, but we don't have information about opening stock.
Okay.
Got it?
Yes, sir.
Yeah. So everyone got this summarized P&L and balance sheet? You were able to solve it? Yeah. Were we able to solve this, everyone? Yeah.
Yes, sir.
Okay.
Yes, sir.
Let's do one small question now.
Sir,
Yeah.
this PDF will be uploaded on the portal or not?
This is there on the portal. The question thing. Are you talking of the question?
Yes, sir.
Yeah, it's there on the portal under the regular lectures tab. In that assignment, you will find. Okay. Chalo, try out this question number.
Sir, on assignment page, sir.
Assignment page. Yeah. Let's try to solve this question number 9 easily. Let's do it together, guys. Question number 9. And then we'll call it a day. Second lecture of FM. Next week, I think next Tuesday, we have the lecture again on ratio analysis, where we'll be again doing some more questions.
सर हम लोग का फुल्ली कब कंप्लीट होगा मतलब कब तक कंप्लीट होगा?
Fully regular lectures तो चल ही रहे ना शाम को.
उसमें मतलब कितने मंथ लगेगा?
I don't know. I mean, October, November तक तो चल रहा है शायद. I'm not sure. I haven't seen the timetable. Chapter 1 and 2, it's not there in the revisionary session. Chapter 1 and 2, you will find it in the regular lectures. Regular जो शाम को हुआ, I think that is done. I think कुछ 15 या 16 सितंबर को हो चुका है. Okay, so देखो profit after tax is 2,70,000. So we have PBT of 2,70,000. इसमें से tax less करेंगे, which is 35%. No, it is already after tax. My bad. Profit after tax 2,70,000. Equity dividend paid is 20%. Market value of equity share is 40. Earnings yield. Now, to get the earnings yield, we will need to calculate. We'll need to calculate the amount of PAT to hai and dividend yield. So, what is the amount of dividend that we are paying? The dividend that we are. Yeah. From before
20%.
this. Yes. So, from this PAT, we'll have to essentially pay first the preference dividend. The preference dividend is 9% of 3 lakh, which is 27,000. That will give us net profit for equity shareholder, which is 2 lakh 270 minus 27, so 2,43,000. Okay, and then dividend per share is 20%. So 20% means 2 rupees, correct? Because dividend is 20% of the face value always. So we get the dividend yield as DPS, which is dividend per share, divided by the market value, which is 40. So that's like 2 divided by 40, which is 5%. Then cover for preference and equity dividend. Now cover is simply going to be PAT upon equity dividend plus preference dividend. So PAT is 2,70,000 upon equity dividend is 2 rupees per share or 2% of the share capital. You can say 8 lakh into 2%, which will be 16,000 plus 27,000. Right. So this number will be 2,70,000.
Sir, total share capital 11 lakh is there, right? Preference share is 3 lakh and equity.
Yes. So you pay equity dividend on equity shares only. Right.
No, sir, whether it is 8 lakh or 80,000.
8 lakh. 8 plus 3, 11, right? So 270 divided by, this will be 43,000. Yeah, so cover is 6.279 times. It means our income is 6.279 times of the preference dividend, equity dividend that we have to pay. Earnings per share, of course, earnings per share will be 243 divided by 8,000 number of shares. And price to earning will be?
Sir, hello, sir.
Yeah.
What is the cover, sir?
What is the cover?
Yes, sir.
To pay preference dividend, equity dividend, you need profit after tax, right? So from PAT, you are going to pay equity dividend and preference dividend. So in the denominator, you have to pay 16 and 27,000. And to pay this amount, you are earning 2,70,000. So your income is basically 6.27 times of the dividend that you have to pay.
सर ये क्या बोलते शेयर्स 80,000 हुए ना?
Shares 80,000 होंगे, yes.
तो सर 80,000 शेयर और 2 पर शेयर है तो फिर 1,60,000 हो गया ना? 1,60,000 हो गया ना ये इक्विटी?
एक सेकंड, ये 8 लाख है ना? हाँ, yes, 1,60,000 होगा, correct. Yeah, correct. So this will become 2,70,000 divided by 1,87,000. So it is 1.4438 times. Okay, so 1.4438 times is our income. Price to earning is simply the market price, which is 40 upon earnings per share of 2,43,000 divided by 80,000, which is 3.0375. So price to earning is 40 divided by 3.0375, which is 13.16 times is the P ratio. Okay. Fine. So with that, we have done quite a good number of questions in our today's class. Yeah, next lecture we'll do some of the past questions, some RTB questions, and also we'll be doing the DuPont analysis. Okay, guys. So with that, let's call it a day today. See you again in the next Tuesday's class. Bye-bye, guys.
Thank you, sir.
Bye-bye. Enjoy. Take care.
Thank you, sir.
Thank you, sir.
Bye-bye.
Thank you, sir.